You ever look at a company's financial report and just get the feeling you're not seeing the whole picture? Well, you're probably right. Often, those first numbers you see are like a first draft, not the final edited story. Today, we're going to peel back the layers and find the real story that's hiding in the numbers.
So let's jump right in with a real world example. This is Kraus Consulting, and what you're looking at is their trial balance for the end of May. On the surface, it looks pretty good, right? Debits equal credits, everything's balanced. It seems totally buttoned up. A perfect financial picture. Or is it?
Yeah, does this one snapshot really tell us everything that went down in May? Think about it this way. It's kind of like a selfie you take before a really hard workout. You look fresh, you look fine, but it doesn't show any of the sweat or the actual work you put in. That initial balance sheet, it's missing a ton of the action. To get to that real story, we have to talk about a super important rule in accounting. It's a core principle that makes sure the final numbers are telling the truth, the whole truth, and nothing but the truth.
And that rule is called the matching principle. And its job is simple, but it is so powerful. It's all about getting a true picture of how profitable a company was in a specific period of time. It says, hey, you've got to record expenses not when you pay the bill, but in the exact same period that they helped you earn money. So for Kraus, we need to know exactly what it cost them to make their May revenue in May.
Now, this is really the whole heart of what we call accrual basis accounting. You've got the simple way, the cash basis, which is exactly what it sounds like. Cash in, that's revenue. Cash out, that's an expense. But the accrual basis, well, it's a lot smarter. It records things when they actually happen, no matter when the money moves. And that gives you a much, much more accurate picture. The matching principle is what makes it all tick.
Okay, so let's see how this actually works. We're going to start with the first kind of adjustment, which are called deferrals. Basically, these handle situations where cash was paid out or received before the real expense or revenue actually happened. So we've got some extra info here that wasn't in that first snapshot. Clue number one, Kraus Consulting used up $900 worth of their office supplies in May. Now, when they first bought those supplies, they were an asset, something valuable the company owned. But now that they've used them up, part of that asset has turned into an expense.
So, how do we fix the books? With something called an adjusting entry. We're going to debit the supplies expense account for $900, which basically just increases the expenses for May. And at the same time, we credit the supplies asset account, which lowers its value by the same $900. See, we've perfectly matched the cost of those used supplies to May, the month they helped make money. Okay, next. Kraus had $2,000 in something called unearned service revenue. This is just cash they got from a client before they did the work. That makes it a liability. It's something they owe the client, either the work or their money back. Now, the new info tells us only $400 of that is still unearned. So, what does that tell us?
It tells us they earned the rest. They did the work. So we've got to adjust the books. We'll debit unearned service revenue to knock that liability down by $1,600. Then we credit service revenue to bump it up by that same amount. Just like that, they've officially earned that money in May. And their books are that much closer to the real story.
What about the big stuff, like office furniture? You don't use it all up in 1 month, right? But it definitely helps the business over a long time. Well, the process of spreading its cost out over its useful life is called depreciation. And we're told this furniture's cost is being recognized at a rate of $190 a month.
So here's the adjustment. We debit depreciation expense for $190 to match that cost to May's business. But instead of lowering the furniture's value directly on the books, we credit a special account called accumulated depreciation. This is actually a really clever way to keep track of how much of the asset's cost we've used up over time without changing its original price tag.
All right, now for the other side of the coin, accruals. You can pretty much think of these as the opposite of deferrals. Accruals are for recording revenues you've earned and expenses you've incurred that haven't shown up on the books yet, usually because no cash has actually moved. Okay, check this out. The month ends on a Wednesday, but payday is always on Friday. Now, the employees worked on Monday, Tuesday, and Wednesday in May, so they've earned 3 days of pay. Kraus owes them that money for the work they did in May, even though the paycheck itself won't be cut until June. So how do we account for that? First, let's do the math. 2 employees, $700 a week each, that's $1,400 total. They worked 3 out of 5 days that week in May, which comes out to $840. So we debit salaries and wages expense to match this labor cost to May, and then we credit a new liability account, salaries and wages payable, because, well, the company now officially owes them that money.
All right, last one. We're told that Kraus did $1,700 worth of work for clients, but they just hadn't gotten around to sending the invoices by the end of May. So they did the job, they earned the money, but right now it's not on the books anywhere.
But according to our main rule, the matching principle, it doesn't matter one bit that the invoice is missing. They earned that money in May. So we debit accounts receivable, which is an asset that represents money owed to the company, for $1,700, and we credit service revenue for the same amount. Now that revenue is sitting right where it belongs, in the month it was actually earned.
Phew, we did all the hard work. So, what was the point of all that? Let's take a look at the payoff. Let's compare the before and after to finally see the true picture that we've just uncovered. I mean, just look at the difference here. Before, the books said they had $1,900 in supplies. After, it's the correct $1,000 that's actually left. Their salaries expense jumped from $6,400 to over $7,200, which reflects the real cost of their labor in May. But the biggest, most dramatic change of all was to their revenue.
Before we did anything, the books showed that Kraus Consulting's revenue for May was $9,500. After we adjusted for all the revenue they had actually earned from both the prepaid work and the unbilled jobs, the true revenue for May is $12,800. That is a massive difference. That is the real story of how they performed. So you see, adjusting entries aren't just some boring accounting rule you have to follow. They are about finding the truth. They take a blurry, out-of-focus snapshot and turn it into a high-definition picture of how a company is really doing. And that leads us to the most important question of all. With this accurate picture, what real-world decisions about hiring, about investing, about budgeting can the leaders at Kraus now make with total confidence?